Just like that, the Fed has officially started the cutting cycle with a double cut, which I was personally against, and the market reacted by doing absolutely nothing. Well, at least nothing notable. The most important thing going forward is really the intermarket relationships between the three major indexes and bonds. So welcome to the Trade Brigade Midweek Show. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off with a closer look at the SPY daily time frame chart, what do we see here from an overall trend perspective? The trend, of course, is up. We have lows, higher lows, and it's very possible that we can look for more higher lows on the daily time frame chart because, as you'll see from here to here, we just found brand new higher highs on the daily time frame. So the trend is technically up, and if we pull back, it's from the highest high in the sequence. Higher lows are available to continue the trend in the upward direction. 555.50 is the main level that we want to watch for because it represents the bottom end of this previous balance range from over here. It would also keep us over the Wednesday high of last week's reversal rally off of this crazy low. So 555.50 is the key level to watch, and the reason I think it's in play is because of today's daily structure. We've printed a daily inverted hammer where in the upper wick there's clearly not a lot of price acceptance from the bulls, and we've closed weak down towards Tuesday's lows, forming a two-day low flush point. If we were to break down below that, we're sort of back inside of this balance range, right? And looking for the bottom end to come into play. Once again, that's 555.50. So if we can spot buyers over here, I'd be looking for something like a daily hammer candle, an hourly double bottom, give or take, an hourly inverted head and shoulders off of that level. I'll be classifying that as a daily higher low opportunity. And as described in the Saturday weekly watch list episode, what's the major threat here? If we made a new all-time high and broke through 555.50 and found a lower high underneath, this would be a big cause for concern. Now we have trapped overhead supply, who potentially bought in on the all-time high breakout. We have this turning back into overhead supply, and it puts the reversal in jeopardy from the Wednesday session of last week. At this point, an equal low flush underneath something like your daily 50 SMA gets dangerous, at least to the equal low, if not kicking off some sort of attempt at a weekly downtrend. Let's not speculate too much on that as of right now. Clearly, we're not underneath 555.50, but that's the larger threat to the downside if the bears are really going to take control of this market. As of right now, I would say that this is probably the primary outcome that I'll be looking for. Once again, trying to scout daily hammers, hourly, inverted head and shoulders, double bottoms, any support off of 555.50 would be a reasonable daily pullback. Let's bring it on down to the hourly time frame chart. We'll get even more granular, and we'll start to talk about how this pullback could unfold. So once again, you can see in the upper wick of today's session, this is the FOMC volatility, there really wasn't much price acceptance up here. We'll see it on the market internals. There wasn't a lot of exchange level participation towards the upside there. The value area on the market profile will not show us acceptance over that previous all-time high. And we can see the close week underneath the two-day highs from Friday and Monday of the last and this week. So walking forward, what's the game plan? Well, the Man Ray pattern starts to emerge, and, of course, that's this guy right here. It's basically a head and shoulders with a double top, right? Any sort of lower high acceptance underneath the two-day high breakout point in here at 562.50, in my view, kicks off the pullback and really makes it reasonable into 555.50. So you might look to exploit risk-reward that sort of travels through this range right here. Now, this dotted line at 558 is the intermediate lows of that balance range. You'll remember that we had previous support, intraday support, right? Then it acted as resistance, back to support. So there is something to say about 558. It's worth putting a little bit of respect on that level, and we'll see if the market wants to get hung up at it, but ultimately the target should be into 555.50. Once again, when we get down here, if there's some sort of double bottom that can emerge, if there's some sort of, let's just say it looks like an inverted head and shoulders, that would likely give us some sort of daily hammer candle, right? I would then try to take it long over that neckline to rotate back into these highs, noting that from here to here, we would have a daily higher low happening over the 50 SMA. So once again, that's the bullish situation. If the bears are going to make a stand for it here, it should really be like a sharp and rapid breakdown under 550, 550. Maybe you support on the initial go around off of 549, but a lower high that's set underneath really starts to become dangerous for now. Once again, overhead supply. Is there the opportunity for an equal low on the weekly time frame chart down here? Absolutely. Closer to that 540 zone that we talked about on Saturday. What do we see in terms of the Fibonacci's off of the low from the Wednesday reversal up to the most recent high? The 38.2 Fibonacci is aligned with that 558 level we were just describing. So if there is support arbitrarily, I wouldn't even say arbitrarily actually, if there is support off of this structurally maybe less significant, but still their level, it would make sense based on a Fibonacci here. Generally speaking, I would still use 550, 550 as the line in the sand, even though the Fibonacci 38.2 is not necessarily aligned beautifully. If we take a look at the intraday anchored view apps, what are we seeing out of this? Once again, pretty decent alignment with that 558. So once again, maybe putting a little bit more of an emphasis on that particular level. But over time, let's just say that this pullback is nice and mild, which would be a bullish indication if it's an orderly pullback, right? An orderly pullback into this area, if it takes its time, maybe you're getting confluence out of this anchored view app, which comes from the original breakdown of the balance range back here anyhow at 550, 550. So thinking about all those key levels. One thing I have not really acknowledged here is just that any price acceptance tomorrow morning over 562.50, anything that's consolidating up here, is really just bullish consolidation. I would be hard pressed to say anything bearish about the market under that circumstance. My only concern as of right now is, once again, the daily upper wick and sellers seemingly stepping up as we were attempting to travel into blue sky territory. So the pullback seems more likely, but not an Armageddon style crash here for the broad market. Let's jump into the market internals for the NYSE side of things, not the NASDAQ. And if you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. We're focused on the 3 days that have happened so far, Monday, Tuesday, Wednesday. You can see, as we were trading near these all-time highs, it's not like volume flows were substantial, up around 300 million. The earlier sessions in the week were really mild, I think in anticipation of FOMC, so you didn't get much volume commitment there. The advanced decline line, definitely more bullish than bearish, but nothing notable, not really any time spent up here in trend higher zone on Monday, Tuesday, or even today's Wednesday session as that all-time high break was taking place. The index score intraday has been really mild and, building a little bit more negative here on Tuesday, Wednesday morning as we were getting that pullback, but nothing substantial where, we were severely extended through the, strong reads over 1520 or under negative 15, negative 20. Nothing. So the market's really, as I was saying in the intro, hasn't done anything notable up here. It's really digested the move quite reasonably, I would have to say. If we look at the ticks, again, all over the place on FOMC, but what is the cumulative build doing this week? Nothing substantial on Monday, nothing substantial on Tuesday. Today, absolutely flat into the close. So is it fair to say that this was an overwhelmingly bearish reaction near the all-time high? I don't think so. I think that a pullback can unfold, but it's nothing to the degree where I'd be looking for a huge market crash. Here's the market profile. If you're not familiar with the profile, check out this video tutorial in the top right-hand corner. And it's just a rinse and repeat of what I've already been saying. Not a whole lot of price acceptance near that all-time high break. You can see that value area was left lower in today's session. The point of control migrates ever so slightly in the upward direction relative to the Tuesday session, which was also slightly higher relative to the Monday session, but nothing here is overly indicative of strong acceptance at those all-time highs or some sort of look that would sort of suggest continuation to the upside. I think if anything, the market's fairly content in this range, right? You can see that the value has kind of been magnetized back down towards this area, and I wouldn't be shocked to see some sort of pullback into familiar prices that we've already talked about. So nothing crazy here. We have a great excess high in J period. We have a great excess low in M period. So no poor highs to repair, really. We've, of course, repaired the lack of material excess here on Tuesday. Same thing on Monday. Same thing from Friday. This low's all set. This has been repaired. Really not much to talk about. A very reasonable market as we've been describing so far. Let's jump on over to the NASDAQ side of things, see what's going on with the QQQ. Let's bring this back to our classic set here. There we go. Thanks for bearing with me. And this is where we start talking about these intermarket relationships between the indexes, right? Because the S&P attempted to make new all-time highs. And if you recall the commentary from the Saturday video, if the NASDAQ couldn't at least make it to the pivot high, forget about the all-time high for now, but we wanted to make it at least to the pivot high, not even close, right? You can see that we looked above this flat top in here on today's session and then closed back inside of this range. Now, again, the argument's not Armageddon, oh my goodness, it's doom and gloom, NASDAQ's going to zero, because just like you can count, we have highs, lower highs, possible lower highs, you also have lows, higher lows, and there's a reasonable opportunity that you might get some sort of higher low here at the daily 50 SMA. You could even go a little bit further. This is our line in the sand here. That's at 458.50. This, by the way, the level I was just referring to, the 50 SMA, is aligned with 468.35. You can see from this previous range, the market was very choppy in that area. So I don't think it's doom and gloom, but it's certainly not a strong indication that would give me a ton of confidence that the S&P 500 should be moving into and should be accepting into all-time highs. Because you're disjointed here with the NASDAQ, it would make sense to me once again that the pullback in the S&P would seem reasonable rather than unreasonable. So what do we have out of this structure? Once again, inverted hammer closing at a 2-day low flush point. I don't know that I would be short here immediately at the lows for some sort of pullback. I think you're already approaching support here out of the QQQ NASDAQ. So I'd take it day by day. If there is some sort of break and lower high Brigade bolt under 468.35, that's where your key line in the sand really comes into force here at 458.50. So with that, I would say that the daily trend is mixed with those lower highs and higher low opportunities we just described. Let's take it down to the hourly to get a little bit more granular here. As of right now, this really suggests more of a bull flag on the hourly time frame chart. I'm not seeing the reason to say like, oh my goodness, doom and gloom. And once again, that's simply noting that we're over this key support at 468.35. Any consolidation up here, in my view, really just is bull flag consolidation, and the Fibonacci's agree. We talked about this in last Saturday's video. There's your 38.2, slightly misaligned with that 468.35, but not by much. You've got the 50 SMA, the key horizontal level, the 38.2. I believe if we come in here with the intraday anchored VWAPs, you'll get, ooh, that did creep up a little faster than expected. Over the weekend, it was right here, right? But this is going to slowly migrate higher over time. Generally speaking, I would remain more neutral out of the NASDAQ than anything else if we're contained in this balance range right here. You might be able to pull off some intraday scalps, some intraday trades. I'm not telling you that there's nothing to do from an intraday perspective in this box, but the general movement out of the market will become a little bit more clean when we can get up and over 477 or when there's a clear breakdown with acceptance underneath 468.35. So it's almost a waiting game out of the NASDAQ. Now, again, putting the pieces of the puzzle together and linking back to the S&P 500, the intermarket relationships, if you're looking for the S&P to make a break for new all-time highs, or if you're looking for that pullback to be bought off of 550, you probably just want to see consolidation and an attempt to get over 477 out of the NASDAQ, right? If the S&P pulls back and the NASDAQ is also making a break underneath with a lower high at 468.35, absolutely a cause for concern. And like, you better believe I'll be the first one saying, hey, this is a red flag. You know, we're not really getting that beautiful confluence out of the indexes syncing up for acceptance at all-time highs, or, you know, what it would really take to classify the market as fully risk on and bullish. So that's what I'm seeing here. If we're trying to really dissect price action, put yourself in the shoes of a buyer, if you start to get this break up and over the previous pivot high, which is a flat top, you would expect some sort of stop run to accelerate prices. The fact that there was no acceleration here, and I get it, it was an FOMC day, so it's very hard to actually read into like, oh, this should have happened and it didn't when we have a catalyst like we did, but generally, the lack of acceleration over this very well-defined area of resistance kind of strikes me as being kind of a failure from the buyers, right? So a little bit more neutral through this box into the remainder of the week, as we were just describing. Let's finish up the NASDAQ with the market internals for that exchange, as well as the market profile. You can see here we actually did close out negative on the volume flows. We were close to substantial inflows, but it was very short-lived on that FOMC. As we take a look at the advanced decline line, most of the week spent in the positive territory, but nothing meaningful in trend higher zone, and just like in the S&P, cumulative builds out of the tick that are basically negligible, nothing to really read into there. Let's jump on over to the market profile out of the NASDAQ, and you can see the same things where the value area is technically lower in the session. You can see the point of control is actually lower on a day-to-day count from the previous Tuesday session. Tuesday was definitely higher than Monday, but generally, same concept as the S&P, the market seems more comfortable in this zone right here. And until we can actually start getting new price exploration out of the zone, I think it's really just a patience play here and sort of taking that back pocket approach of saying if the NASDAQ's not getting in gear, I don't know how trusting we want to be of that S&P near all-time highs. Let's finish up the three indexes with the IWM cash ETF for the small caps here. And there's a much more severe reaction, or at least the bar structure looks more emotional and panicked and severe on the daily chart. But again, generally speaking, was there anything so crazy that happened out of small caps? No. We know that there's three big ranges out of small caps. We have bullish activity up here, bullish acceptance inside of this previous range. This is kind of no man's land in here. And then we've been calling this the hard place, right? A rock, no man's land, hard place. If you get caught in the middle, it's not really the greatest place to be. So we're still in bullish territory in that upper third here. However, again, let's read into the daily structure. Look at the upper wick of today's daily bar. It looks over the previous day's high, looks over this weekly pivot high, and then it closes basically for two equal lows, unchanged in here. Lack of price acceptance near these highs. We know that small caps are usually more sensitive to that R word, recession. So a breakdown underneath these two equal lows, it's very critical that the IWM finds support off of 215. So in the intro, when I'm talking about, the most important thing to watch is the intermarket relationships. Once again, we talked about how the NASDAQ influences the S&P, but the IWM will also be an influence at 215. It looks very likely that the market could pull back after this nasty inverted hammer, failing to find acceptance over the highs, right? So if this happens, it's all about 215. If we hold, great. Fine. S&P maybe gets a little bit more of a stronger, broader indication behind it. But if it just slices right through 215 and we get back down into no man's land in between a rock and a hard place, this zone, I'd be hard-pressed to say anything really bullish about the S&P. Now, pair that with a NASDAQ that maybe also pulls back or is just continuing to chop around in its range, and all of a sudden, it's like, I don't want to be a buyer of new money longs up in the S&P at the all-time high if we're not getting follow-through out of the NASDAQ and small caps at the same time. So 215 daily 50 SMA, the blue moving average on my screen here. It's a big watch into the end of this week. If we're underneath, it's really not a helpful case for the S&P 500. Let's take a look at the hourly time frame chart. See what else we can learn in here. Rinse and repeat again. I know I sound like maybe a broken record, but this equal low flush point, very, very interesting. Obviously, you're all stacked up there from the Tuesday session as well as today's Wednesday morning and even the FOMC launch pad, if you will, before it's basically fully reversed and came back down to earth. So 218.35, any Brigade bolts intraday underneath. It's all about 215. When and if we get here, you need to spot the double bottom. You need to spot the inverted head and shoulders. You need to spot the daily hammer candle if we want to remain more bullish in the S&P 500. If these things do not happen, we fall back down into no man's land, and I would just say once again, probably putting the pressure to the downside on the S&P. We can quickly check in on the intraday anchored VWAPs and see what's going on here. There's your cluster. We're above it all. I would say that's mostly aligned with sort of there's probably some case to be made for strong support, or at least an attempt of support at 215. So the takeaway from that would just be if we can see all of these things stacking up in here, if there isn't a strong response from the buyers at 215, I would definitely take that as an indication and a huge failure there from the buyers. And once again, probably changing stance in the S&P instead of being more neutral, probably looking for that aggressive pullback we were just referencing. If this is going to remain positive over 218.35, fine, so be it. I would want to start seeing some sort of constructive trend build intraday up and over 222.15 if we're going to remain bullish or actually look for substantial upward pressure in the S&P 500. A quick check-in on the Fibonacci's, then we'll jump into the internals for the Russell. What do we have here? 50% retracement is right at the 215 level. 38.2 is kind of arbitrarily stacked in this zone in here. Wouldn't really read into this too much. Generally, I think that the daily structure and those levels, those bands we were just talking about here, and here are the primary watches instead of just sort of looking at the fibs on this particular move. Let's jump into the internals for the Russell side of things. We'll take a look over here and we'll see a lot of similarities to the S&P more so than the NASDAQ, where you have mild inflows, reversal back down to the zero line, but not negative. The cumulative tick is flat on Monday, a little red on Tuesday, a little red on today's session, positive territory, nothing substantial in trend higher zone, rinse and repeat. You're not really seeing stronger sellers step up, but buyers at the same time, are also not doing anything substantial. I think the market's basically waiting for more information here. And when I say information in this sense, I'm particularly referring to either initial jobless claims tomorrow morning or continuing claims, or the next sequence of major reports. We're talking about CPI inflation, we're talking about PPI, we're talking about unemployment rates, right? That next set of information will be really critical on the heels of the rate cut from today's session. Here's the market profile for the Russell. You can see, again, not much changed here. Here's the value area on today's session. Here it is on Tuesday. Here it is on Monday. Really poor low on the Monday session. So carry this forward. These lows are mechanical because they're so precise. Tuesday and Wednesday. If we break and test Monday's low, I would also expect Monday's low to break down. just because of how poor this structure is back here. There is no excess low on the Russell futures. So expect a breakdown there. Once again, this probably leans a little bit more so towards a pullback in the S&P if we're putting together all the pieces of the puzzle. Let's jump on over to the S&P sectors and really see what's going on here at that level. Weekly performance is what we want to evaluate. At the top of the list, it's going to be the XLE energy sector, up 1.85%. Decent little recovery there considering our discussions around crude and the lack of global demand for crude right now. Financials also performing okay this week, up 1.1% so far. Then finally, the tertiary read is communications, up 0.65%. At the bottom end of the barrel, it's real estate getting hammered, down 1.21%. There we go. Consumer staples down 1.2%. The XLV healthcare sector down 1.03%. So the most important takeaway there is probably healthcare being the third heaviest weight sector, down over 1%, whereas your XLK, it's still down this week. Even the defensive heavyweight sector is not really performing well here. I'd say financials are your heaviest hitter in the upward direction here. Let's check in on the structural charts and just evaluate what's happening. So out of energy, it really seems to me like this is a great spot for a lower high. I mean, the trend obviously is down through this move. You can see that this is rejecting the daily 200. The 50 SMA is right there as well. Great little counter trend move that's setting up a rejection of this breakdown point. If you were to consider this a double top, here's the neckline rejection. If you really wanted the nail in the coffin, if you wanted to take this intraday, then you'd be looking for something like this. And primarily, the reason I'm sort of even bringing this up is because I think crude could be setting up for that exact trade if it hasn't already triggered yet, right? You can see the bottom end of this, there's your retest. You're already starting to get a red bar in the downward direction. So intraday breaks lower highs underneath this low, probably set up that continuation into the equal low, which once again, if crude is really struggling like this, really more of a recessionary indication than anything else. Let's jump into financials, which are honestly interesting here because of the way that JP Morgan is actually down so aggressively from that commentary the other week from Jamie Dimon himself. But look at the index itself, or I should say the sector. It's hanging out near this all-time high. Yes, inverted hammer, but I like the fact that even if you retest 44 again, because this was an overshoot here to the daily 50 SMA, if this pulls back to 44 and supports, you could still make the argument that you have a daily higher low from here to here. So I like what financials are doing. I think digestion up here is fine. This has been one heck of a rally off of these August 5th lows. Because it's the second heaviest weight sector in the S&P, I look at this chart and I just think to myself, I can't claim to be a bear in the S&P 500 if financials are just, grinding around in here. It's bullish consolidation near the highs. I mean, maybe over time it turns into a distribution and, we break and then we have to change our tone. But at first glance, this chart definitely looks more bullish than bearish with the opportunity for a higher low pullback on the table. Let's move along to communications. Once again, same commentary basically, where we have a higher high and we have the opportunity for a higher low here off of 85. You have lows, higher lows, possible higher lows. Sure, a pullback could unfold, and we just acknowledged that in the S&P 500. But is it like these charts are rolling over for weekly or monthly lower highs? Absolutely not. Absolutely not. This is a brand new all-time high out of communications on the Tuesday session, equal high on today's session. So inside bar, again, pullback is fine, but the structure does remain bullish. If you look at industrials, same comment, nice little, high put in over here, and a pullback's very reasonable, but where's the higher low? Right off of key structure, 128.25. Can't really be bearish there yet. XLB materials, just nothing but a balance range. It didn't technically make a new high over this swing back here, but again, what's the idea? Any higher lows are available over 91.60. It'd be great if that put it in, but generally speaking, based on the history here, it also wouldn't be a shocker if this just continued to grind around in the range. When it breaks the lows, I'll raise my hand, I'll draw the red flag, and I'll say, hey, this is starting to look concerning. But as of right now, can't really get on that train. Also, just FYI, materials are like the lightest weight sector in the S&P, so it's not going to move the needle all that much. Here's the XLY consumer discretionary, same concepts, right? Inverted hammers back to back, show me the pullback, show me the higher low over 188.75, good to go, looking for continuation. If that changes, we will change our tone, but as of right now, more bullish than bearish. Real estate, let's start getting into these underperformers. What does it look like? I mean, clearly an uptrend. We know that it's been moving in anticipation of rate cuts. And now that the cuts are here and Jerome Powell offered some commentary on, hey, maybe we're going to be data dependent on the next couple of meetings, If this is like pricing in the fullest extent of the move, then fine. What do you get here? A pullback and some sort of higher low, some bullish acceptance. It's really not much of a concern. Also a very lightweight sector for the market. So, again, pull back, fine. Show me those higher lows. That's what I'll be watching for. I know it sounds like a broken record, but trust me, it'll change in just a minute when we get to the semiconductors and the tech sector. Here's the XLP consumer staples. You can see consolidation up here is fine. Again, not much to talk about, so let's just move along. XLV, maybe a little bit of a double top with the lack of a higher high here, but remember, it's not a double top until it is, requiring a breakdown underneath 154, in which case I would still be looking for something like a weekly higher low, off of 150 and the daily 50 SMA in blue here. So not the end of the world. And if it does just consolidate, fine. And even if it pulls back, right? Let's remember this. Although it's the third heaviest weight sector by market cap, it's also D for defensive. So if healthcare pulls back and gets this test, or heck, it even consolidates in here, I'm not overly concerned with that if the slack can be picked up out of semiconductors and the tech sector. So let's talk about those now. We'll cover back to bonds in just a second. So just as quick as this turned from a head and shoulders into a double bottom, it's probably turning into, hey, look at these lower highs, and it's really just a fake out right shoulder back down to the lows, right? So call it whatever you want to call it, just like we talked about out of the QQQ cash. I think that you want to watch this as a broad market indication. If you fail to get up and over 237, I'd be hard-pressed to be overly bullish out of the tech sector itself. You can see today's daily structure doesn't look all that great, but you can't deny it the opportunity for some sort of higher low attempt up and over 228.50. This is really more so a balance range more than anything else right now. So walking forward into the end of this week, how do we want to trade this? Bullish outcomes, bearish outcomes. It's really that simple out of the semiconductors. You have 237 and 228.50. Matt, I don't trade semiconductors. I don't trade tech. I just trade the ES. Great. Same exact thing. Bullish for the ES, bearish for the ES. Really do not overcomplicate it out of the semiconductors. Massively influential over our markets as they currently stand. Let's move along to the XLK tech sector a little bit better, just because you can clearly see here the attempt for some consolidation over this 218. And I would still argue a higher low that's found over this 212 is very important. Why is that the case? Because if you take a look at the hourly structure, there's virtually nothing here. So if the market is going to break underneath 218, bring on the pullback. That's fine. Honestly, I'd prefer to repair this structure by rotating through it, finding a better higher low at 212, and then trying to rotate back in the upward direction. Now, of course, you'll have to battle back up through 218. I'm not saying it's just going to be easy, this blink of an eye type thing, but generally, this pullback through here should be quick, and if buyers are really going to step up, as we talked about with IWM 215, you really want to see a strong reaction off of this 212. Why? Because that's where Wednesday's reversal really started to get underway, breaking out over these highs, retracing this thin structure on the way down. So 212 is your key area of support, and the pullback seems somewhat likely with the close today underneath 218. Also tie in everything else we've been talking about. Here's utilities, the most bond-like sector, pulling back from the new all-time high. Fine. Show me the higher low. D for defensive. If it continues to push to all-time highs, and this is actually, make note here, right? Make note here. The SPY pushing to new all-time highs, being led by utilities. This is that classic red flag behavior that we were just describing. Or we describe on the channel frequently, right? So this is a pure play example of that. The market made a new all-time high today, sort of being led by utilities with the tech sector and semis pulling back. Doesn't give me a whole lot of like warm and fuzzy feelings inside about the S&P 500 continuing to get acceptance, which again, we've acknowledged already in the analysis. It seems more likely that a pullback would unfold. Utilities would reinforce that same exact idea. We said that bonds would come back towards the end, so here we go. Bonds pulling back. Why are they pulling back, Matt? I thought, the Fed's cutting rates. These things should be ripping to the upside. Same comment as the real estate sector, honestly. A lot of the move was priced in here, and now that Jerome Powell is maybe a little bit more reserved on his commentary about what the future path of interest rates looks like and the pace of rate cuts, I think rightfully so. Bonds have cooled off a little bit. You're getting a little bit of profit taking out of the TLT, and keep in mind, if people are taking profits in bonds, and this is kind of a sick and twisted relationship to keep tabs on, if people are taking profit in bonds because of the rally and now the slight uncertainty about the path forward from Jerome Powell, what would that mean for interest rates? Well, as bonds come down, rates go up, right? And what do rates going up do? Probably put more pressure on things like semiconductors, the tech sector, everything that was just like, oh yeah, yippee, the rate cut's finally here. Well, if there's massive profit taking in bonds, don't expect that to be all that euphoric, and that sort of explains some of the reactions that we've been seeing so far. Let's jump into the ratio grids and see what's going on from that perspective. And if you're not familiar with this dashboard, by the way, check out the video tutorial in the top right-hand corner. The XLK is rolling over underneath a downward sloping 50 SMA. This continues to scream, hey, we do not have a full-blown risk-on style look. XLF kind of counterweighs that a little bit, but remember, this is the top dog. XLF is the second tier. If you look at the XLV, it has the opportunity for a higher low at an upward sloping 50 SMA. Remember, this is D for defensive, so once again, we do not have a full-blown risk-on style look. XLY, maybe the combination of these sectors here might outweigh the pain that we're seeing in the XLK, and I believe, and this is sort of why the market's acting the way it is. This is why we're seeing things like the S&P near all-time highs and the NASDAQ not so much, right? If we look at the risk-off sectors, they are pulling back. I'll give some credit where credit is due. I mean, these things are not completely ripping to the upside on the announcement of the 50 basis point cut. You can see the same thing here out of utilities, more so sideways than anything else. But once again, if we're looking for a full-blown risk-on style look, you probably want these things trending in the downward direction. We can see some specialized ratios mimicking a lot of these looks over here, where, yeah, I mean, you've gotten a substantial move higher, but once again, really just more so compressed than anything else. It's not a clean uptrend here. Looks more so like uncertainty, if I'm being quite frank. This is the SHY over the XLK. This is the XLU over the XLK, right? So as we look at this, probably looks more risk off with the possibility of flushing these equal lows, probably causing that pullback to unfold in the S&P 500. And there's a lot of discussion as well about growth versus value. So what you could do in here is we can just edit this from the XLK XLU. Let's just pop in the XLP. It's basically going to be the same exact chart, but let's just go through the exercise. I mean, you can see for yourself. We have a lower low, and this is certainly an opportunity for a lower high. So is there a preference for growth, value over growth? It would seem so based on this indication right here, which again, probably leans a little bit more into that recessionary theme where people are looking for safety, not necessarily that massive outperformance from things like technology, right? This is apples to apples. This is XLY, XLP, getting a break of the neckline. So this actually would counterweigh what we just described over here, where there actually is some preference for discretionary versus consumer staples, and then semiconductors versus healthcare, also suggesting not fully out of the woods. We've talked about the Japanese yen carry trade enough here. Again, remember just that the Nikkei is going to be your gauge. Unless this actually breaks for some sort of massive swing low, I really don't think it's something that you got to be overly concerned with. Notice how it's just kind of double bottoming maybe over this big inflection point, and just to show it on a candlestick chart, we're all set here. No crazy causes for concern. So if this really makes it a break for it down to this equal low, we'll be concerned, which is why I have this alert. But as of right now, so far so good. So all set out of the yen carry trade, not really sparking any of those old concerns from August 5th. Here's the dollar, just kind of stagnant down here in this consolidation range. No, not a shocker considering what's happening with rates. If we take a look at gold, obviously a lot of the same commentary as to what's going on with bonds and the defensive stuff, right? Everybody sort of priced in the massive move. Now a little bit of profit taking. As long as this is over 25.65, I would honestly just consider it bullish in the overall trend and looking for a continuation to the upside. The bears would probably build an edge if all of this turned into overhead supply underneath 25.23. Next up, we'll move along to interest rates, which again, it might seem like a crazy relationship, but how can interest rates possibly go up on the day that the Fed cuts rates? Because of what we just described. Profit taking in bonds sends interest rates up, so the TNX slight uptick on today's session. Not a big shocker over here. The inverted ZT is going to continue to give us some insights as to what the Fed is likely to do. This was pricing in the rate cuts over here, and as of right now, kind of stable as we walk forward, which is a great segue into the Fed tracker tool in the first place, because what you'll notice here is that for the very next meeting, based on Jerome Powell's commentary today, 67.7% odds of no change going into a pause for the next meeting. So front loading it with a 50 basis point cut and then saying, "Nah, we're going to step this meeting out." So basically, what's that the equivalent of, right? It's basically the equivalent of back-to-back 25s and spreading it out a little bit further. But this meeting is all the way out in November. We're going to have to get through the October data before we actually can say with certainty that, hey, they're going to skip out on that next possible indication. By the end of the year, based on the updated SEP, we should probably land somewhere in here. And let's talk about that now. So SEP, Summary of Economic Projections. This is the document. You can go find it on the Fed site. But what we really care about are the projections over here for 2024 into the end of the year, as well as this. So when I was saying that we probably land somewhere around 425 to 450, it's because of this projection. They've certainly reduced their projection from June. You can see 5.1 down to 4.4, indicating more rate cuts, specifically 3 more to go into the end of the year if we're going to make it to that target. But what's really important is actually reading into the uptick in unemployment, as well as the sort of mildly revised, I would not call this major, but mildly revised lower core PCE inflation. These things over here, to me, indicate a Fed that's kind of torn, right? Because how can you sort of get to a Fed funds rate that's 4.4 with PCE inflation not yet approaching 2% flat? It just doesn't seem reasonable to me. These projections didn't really strike me as making all that much sense. The unemployment rate right now sits at a 4.2, and the Fed's saying, okay, we're maybe expecting a little bit more unemployment increase here to a 4.4. But the issue with that is, obviously, once the cat's out of the bag, it's very difficult to stop the unemployment rate from just getting out of control. And perhaps, and Jerome Powell did allude to this in his commentary today, the 50 basis point rate cut is really to try to get ahead of this right here, right? We've seen that unemployment is generally trending higher, but it's not out of control yet. So hopefully, you could sort of think about it like, here's the unemployment rate and it's getting ready for launch. And if it hits this particular point, it's going to absolutely hockey stick to the upside. Jerome Powell is trying to step in right here and say, whoa, hold your horses. Our mandate is for maximum employment. Let's issue a 50 basis point cut and see what that does to the employment situation. Hopefully it prevents this big hockey stick move in the upward direction. Now, a lot of people are saying, it's already too late. So I'll let you decide your personal opinions, but let's take a look at how the Fed is actually thinking about this via the dot plot, as well as some additional indications. So dot plot shows us what? Here is that sort of median projection. There were more people thinking that rates should remain higher for longer versus people who were expecting, rates coming down more aggressively. And what this would indicate to me is that the Fed and maybe other participants in the meeting, not just Jerome Powell, are probably more in tune with, hey, inflation is still a risk. But overall, if we scroll down further, I just want to point this out because this one was also sort of baffling and leaves me somewhat concerned is, what do we want to see? Well, okay, so GDP growth they see as broadly balanced as a risk, but that's not part of their mandate. Let's go to unemployment. Unemployment was severely weighted to the upside. Well, all of the data I've seen out of the initial jobless claims and continuing claims, yes, it's slightly elevated, but relative to like historical trends, absolutely not to the point where a 50 basis point cut should have been issued. I really think that risks to unemployment rate should have been more broadly balanced with something that looked like this, right? Something like that to me would have been slightly more appropriate. But again, who am I? I'm just a guy on the internet that, we're dealing with Jerome Powell, the man, the myth, the legend himself. If we look at PCE inflation, this to me is the insane part, right? Because we've seen on the CPI prints that shelter inflation actually upticked, and that's about 35% of the entire weighting of the CPI print. So to see that they think that inflation risks are broadly balanced, I would still think that they should be weighted to the upside. As a major risk, especially with a 50 basis point cut issued on today's session. So that's a little bit of an update and a walkthrough of the updated SEP. You can continue to read this on your own. Again, it's on the Fed's website. Here is the calendar for the remainder of the week. Of course, we got our Fed funds rate. We talked about all of this. It was the main event. Tomorrow, 8:30, let's get some coffee and donuts up in the penthouse for initial jobless claims and continuing jobless claims, just because it's the first economic data that we'll get after the Fed's sort of statement and commentary from Jerome Powell. So that'll be pretty influential. If this comes in at the expectations, I think we're good to go. If it comes in hotter than the expectations, especially with the market freshly thinking about Jerome Powell and his thoughts on unemployment, probably going to run into issues if this comes in at like 240, 245, 250, probably an issue. We'll also keep a very close eye on continuing claims to see whether or not people are getting jobs after sort of going on leave. So with that, we have our economic calendar complete. There's really nothing on Friday. Hopefully, we're not even at the desks at 2 p.m. on Friday to listen to Harker Hark. We'll take a look at the earnings calendar. We know that tomorrow after the close, it's all about FedEx. They usually have some decent indications as to what's going on with shipping and global demand, honestly. So they might have some insights into the recession word. Let's jump back over to the platform and finish up the initial, or I should say additional indications here for our risk appetite. TLT ratio to the S&P drifts in the downward direction as bonds pull back and markets pull back, meaning that bonds broke down more aggressively here, which is good, right? From a risk appetite perspective, that means the equities are fine. Let's go ahead and take a look over at the bonds relative to themselves, because bonds, again, are going to play a key role in how we walk forward. We're getting counter trend moves, but what are they in the context of? Existing downtrend, existing downtrend, existing downtrend. So is there really an issue for duration risk over in equities? I don't think so based on the data so far. Let's take a look at credit spreads, rolling over really aggressively ahead of the FOMC meeting and continuing to roll over today with a downtick on the short-dated SHY, HYG, and even the medium-term IFLQD. Corporate grade here, still a downtick on today's session. So this is typically a healthier indication for risk appetite remaining elevated in equities. Let's take a look at the HYG in isolation. Really strong move on the FOMC. Yes, it pulled back, but just to what? These prior highs. Whereas obviously here, the S&P made equal highs and then sort of, closed back down underneath on the actual closing print. If you bring out the LQD, it's not all rainbows and butterflies. The LQD did have a little bit of that more temper tantrum move underneath the FOMC volatility. So junk bonds are outperforming. Corporate grade, not so much. Still definitely a higher high. This move relative to this move is still a bullish divergence, and it's something to carry forward. This relationship to me has continued to keep me a bit more optimistic in the S&P 500, even though the QQQ NASDAQ has remained divergent with that lower high. So once this sort of positive divergence maybe breaks in corporate grade and junk bonds, I would then start to think a little bit more aggressively about possible short opportunities in the S&P 500. Let's jump on into Bitcoin and see what's going on with the BTC. Not much. Possible lower high underneath this overhead range. The most bullish thing that could happen here is acceptance over 61,000. Let's take a look at the total breadth. And our moving average charts are improving this week. New breadth as well. New highs versus lows improving this week. So all set on that. Let's jump into the RSP. Reasonable for a pullback. What's the idea? As long as we're over this key level, 172.50, probably looking for a reasonable pullback here in the S&P 500 as well. So the equal weight and breadth overall, along with multiple of the other indications we've looked at so far in today's episode, probably indicate that the first thought should be for a healthy pullback in the context of an uptrend. And if these charts deteriorate more rapidly, we'll have to change our tone. But as of right now, it's certainly not the case. Let's jump into volatility. I'm going to expect that volatility settles down a little bit as the week wears on, now that the Fed is in the rearview mirror. So watching very closely to see if the VIX itself can get underneath 15. That would be a top watch there. If we look at the VVIX, volatility of volatility, watching for the 103 breakdown, acceptance below that would be solid, a good first step. And if we look at the volatility futures, this is in the process of expiring right now. If you go on over to the trade tab, here's the VX futures. You can see that the U contract, the U contract actually expired quite literally today. So we just rolled out to the 28-day as well as the 63-day. So this number is going to be, it's not skewed because it is just the number. It's in slight backwardation, though. I would expect once everything completes the roll by Friday and onward, maybe this pops back into a contango. You can see the 9 versus 30-day VIX is in contango. The 1-day VIX is really elevated, but again, that's just purely based on the FOMC. Into the end of the week, if you're trying to remain bullish on this pullback, ideally, the 1-day VIX would get underneath 1275. All right, that's your key watch there. Let's jump into the core list of companies. Let's finish the job here. Apple is up first on the chopping block. What do we see? Nice gap close. The Stevie Wonder trade played off. Played out, played off, it's all set. So on the gap close, it's definitely worth monitoring here at 222 for a possible lower high. Daily 50 SMA, pullback here. Apple has not really been well received by the market. If you're thinking about iPhone 16 demand, if you're thinking about the iOS launch, which was apparently not that great for iOS 18, they're not even allowing Apple Intelligence. Wasn't that the whole point of iOS 18? Regardless, this does not look like a beautiful pullback anymore. It's kind of looking like a sloppy breakdown here with price accepting now underneath the 50 SMA. So 222 possible rejections. Let's take a look at the hourly chart. If I'm being honest, Apple's been a slug in this box back here. The Stevie Wonder trade was great early in the morning session, but if this just slows down and does, nothing really constructive in these areas, I'm not going to sit here and try to pinch pennies out of Apple. It's just not... It has not been the same great trader it used to be. It's really slowed down a little bit here, as I think NVIDIA has taken the main stage. Microsoft is a main stage these days. Tesla has always been a main stage, right? So even AMD is starting to creep up as being a little bit better. So Apple's starting to slow down from that perspective, and as you can see in this consolidation back here, even on the moves higher, it was very grindy to the upside. losing a little bit of its shine. It's always going to have a special place for the market. Of course, it's like the top dog in the S&P for how many years, but as of right now, not really thrilled with the activity out of the hourly even. So moving along to Microsoft, a much better chart to watch in my opinion because there are two opportunities for higher lows. We did get the gap fill reversal into the end of day on Tuesday. Today into the close, we did end up moving underneath that 432.15. So what does that mean? The next pullback watch is really just the double bottom neckline in here at 425.25. I love the price action out of this chart. If we take a look at the hourly time frame, nice clean breaks in the upward direction, nice stair stepping here in the upward direction. So if this is going to offer the pullback, fine. Get us into this, and I'll be looking for that double bottom. I'll be looking for that more substantial inverted head and shoulders, the daily hammer candle, to then participate back in the upward direction. If it just immediately pops up here, there's probably some sort of intraday breakout trade that can unfold over today's high and the intraday high from the Tuesday session. We're just going to round that off to 40. That'll do as an intermediate level, make it dotted. There we go. So something that looks like this back in range and then breaks there, probably worth a scalp from point A up to point B anyhow. So 435.40, 440.65 would be that upswing and pullback longs off of 425.25 if we get there. Next up, NVIDIA, the one stock to rule them all, is no longer really ruling them all as it just mildly pulls back. It is starting to break down though underneath a 4-day balance in here with the close on today's session, and we do have thin structure underneath. So this is a top watch into the remainder of this week. Any rally attempts that are met with resistance below 115.75, looking for the full move into 109.50 for a larger retest of this area. When we get here, putting the thinking cap on and saying, do we get a double bottom reversal, inverted head and shoulders, hammer candle, all the indications we typically watch for, looking at 109.50 here out of NVIDIA. If it pops back into the 4-day range, you could technically classify it as a look below and fail, but do I want to be aggressive out of NVIDIA in this area? Probably not. The next clean long trade is this, over 120.50, over this pivot high. And what's the key here? Probably looking at something like your SMH up and over 237, right? So 237 will be the key watch out of that, paired with NVIDIA strength over 120.50. You could say, does the dog wag the tail or does the tail wag the dog? Heavy influence from NVIDIA on the semiconductor ETF as a whole, but generally speaking, those two things in confluence would make a strong trade. Next up, Google, the sympathy move back to the upside, winning the lawsuit, $1.7 billion litigation with the EU. So as of right now, I would think that's a bullish catalyst trying to play catch up to the remainder of the tech companies. Remember, let's go to the daily chart real quick. This has been the absolute laggard of the entire market. So any higher lows that sustain over 156.50 is acceptance back inside of this balance from the August 5th gap down. So pullbacks here are great, looking for the top end of the range ultimately over time. If it pulls back and does not support off of 156.50, I think the door is just open for downside. How could it not be, right? The trend is down. 1, 2, 3, 4 lower highs. Acceptance back underneath this range, kind of the nail in the coffin. The buyers have like a quick opportunity to make it happen. If they do, awesome. If not, we're taking advantage of the weakling. We're picking on the weakling and we're sending it right back down for this gap close underneath 156.50. Next up, Amazon. What's going on with Nancy? Daily bars, back-to-back inverted hammers failing to accept over this previous swing high. Similar to Microsoft, I would tend to think that these ideas are more favorable than trying to just long this up here in the chop. So I'd prefer to see a pullback. Is the pullback executable for a short? I don't love it on the hourly, and it's mainly because of this weird outlier day on Monday. Like if you're shorting underneath the 2-day lows, you're kind of shorting into this grind zone. Is it possible to wait for something under 184 to get through this thin structure? I mean, it's possible, but at that point, I don't know. It's the risk reward's not really there. You could try to pick off something that looks like this, but ultimately, I think you're just sort of chasing. You're trying to pick up pennies when the dollar move is waiting for a reversal that looks like this back in the upward direction. So that's my take on Amazon. Obviously, consolidation up here builds this out as a bull flag. Whoa, we wanted to do this. Bull flag like this, over 189.50, clears this flat top. You've got smooth sailing into 195.75. Next up, Metaverse. What's going on with Zuckerberg and the Fantasyland? Looking good so far. Strong name. Really, really been a strong name up towards these all-time highs. Looking for consolidation. Break Brigade bolts into blue sky territories, fly. Any consolidation in here is still bullish. The only time I would be bearish out of Meta, I know it sounds crazy, but is actually underneath 514.75. Reason being is I think that this offers like a daily or weekly higher low. It's not an hourly, but it's daily or weekly. And even if you pull back into this area here, I don't think you have enough overhead supply yet. I think that the overhead supply steps in when and if you're under that 514.75 coming from what we had over here. So that's my take on Meta. Next up, Tesla. This has continued to taunt me day in and day out. Probably a lot of traders. I'm not claiming to be special seeing this pattern, but everybody's looking at this overhead gap, right? Everybody's looking at this support trend line. Everybody's calling this an inverted head and shoulders. Everybody's calling it an ascending triangle. Not the most constructive looking daily bar, back-to-back inverted hammers, upper wick starting to reject a little bit that 234.15, but as long as it's over 226, nothing bearish to say. As long as it's over the support trend line, I still don't think I'd say anything overly bearish here. Daily 50 SMA could possibly act as support. So really watching for this kind of idea as we walk forward. 234.15 closes up to 246.25. And anything that starts to break underneath that support trend line, it's probably not bullish, but I'm not convinced that it's an easy short through this area. What I come back to time and time again is just the Friday session where Tesla was down 9.4%. Think about that. 9.4% and no follow through underneath that low. So strong sellers or just a liquidation break? Probably just a liquidation break. Stronger sellers would have developed a downtrend in here and looked for continuation into the equal low. So not really seeing the case for being a big bear in Tesla, but we'll take that step by step. Next up, JP Morgan. Confused with the XLF sector, right? XLF sector as a whole is up here, ready for a pullback to support over these prior highs. JP Morgan's underneath. So because of that, my fear is that you actually have a lower high brewing underneath that 213.25. Daily inverted hammer could be the signal here for it. If you take a look at the hourly time frame chart, you want to look for an hourly trend reversal with lower highs and lower lows underneath this 207.75. If that's the case, equal low becomes the target, and then obviously big flush point underneath that 201.65, opening up the daily chart for much more activity to the downside. August 5th panic lows come into play at 193.75. Next up, Netflix. What do we see? A little bit of consolidation up here after an attempt on the gap up open this morning to break into blue sky territories. Didn't really receive much follow through, and obviously a bit of a weaker bar here on FOMC relative to some of the other names that we've looked at today. But consolidation in the zone is fine. I would give it another opportunity for a daily higher low, and then a Brigade bolt out of the all-time high breakout over 705.75 would be my top watch. Bears probably step up on this move here. A move underneath 679.25 is the level that I would watch. Next up, last but not least, AMD. This has been the trade I've been scouting. I've been stalking this trade, so I like the fact that it's been breaking down on FOMC. I like the fact that we have this thin structure to the left. I would love to see a continued pullback, not necessarily for the short, but rather to try a long here off of 145.25. If this pulls back, if we find buyers, that's the first place I'll be looking for. I'll give it another shot at 142 as well. Looking to exploit risk reward that looks like this in the upward direction, or if it goes through, obviously it's this, back in the upward direction with respect to 145.25 pending any reaction. If it's straight through it like a knife through hot butter, that's the inverse of the saying, I know. If it's straight through it, then no problem, back up to 150.75. If we do the dance here, don't really support and then slowly grind to 142, obviously you're going to have to respect risk reward that more so looks like this. All right, that is AMD. In terms of sticking with the theme for the additional trade idea of technology, let's go to the dinosaur of technology, IBM. Something interesting going on here with IBM. The recovery effort is real. Obviously, there's a strong uptrend behind this. But what do we see happening here on the daily time frame? Certainly reasonable that a pullback might unfold through this thin structure. You already had a breakdown bar on Tuesday, making a new low. You close near the low. You have an inside bearish 3-bar play setting up as of today's close. So underneath 213.65, the door is open through some of the thin structure. Ideally, the target is this flat top breakout at 204.75. Is it asking a lot? Probably. So take it day by day, step by step, but generally speaking, about 10 points available to the downside. Oops, we don't want E. 10 points available to the downside out of IBM. Here it is on the hourly chart, right? You can see this attempt and then sort of fail into the afternoon. So how does this trade actually execute? Probably looks like an hourly double top, probably looks like an intraday lower high here underneath 213.65, and then you have this thin structure to execute on. I'm not convinced that it just is, like a very quick short through the equal low flush. I would give it some time to set this up because ultimately, remember, it looks great for a possible lower high double top on the hourly, but the daily trend is very strong here. You've got a very strong trend behind you, so it wouldn't hurt to wait for that additional layer of confirmation on the hourly. That's going to do it for today's episode of the Midweek Market Update. If you enjoyed the show or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember that we will have coffee and donuts up in the penthouse for tomorrow morning's pre-market prep at 8 o'clock Eastern Time live here on the channel to discuss at 8:30 the initial jobless claims and continuing jobless claims to determine whether or not we are seeing increased odds of a recession or whether or not the labor market is fine. We hope to see you there. Have a green trading week if not, and as always, I will see you in the next one.